Pound extends post-budget gains against the dollar as Fed policymakers voice concerns on sluggish inflation. Sterling climbs 0.2 PC to above $1.33. FTSE 100 retreats into the red as British gas owner Centrica dives as much as 1.8 PC on profit warning, its sharpest fall in 20 years. Some 823,000 customers deserted the FTSE 100 firm after its recent price hike. Second estimate of UK GDP growth confirms that the UK economy picked up the pace in the third quarter, recording growth of 0.4 PC. With U.S. markets closed this afternoon for Thanksgiving, we're wrapping up the live blog a little earlier than usual, so let's have a look at what's made the headlines on the markets today. British gas owner Centrica has suffered its sharpest share price plunge in 20 years after the Big Six energy provider issued a profit warning and 823,000 customers deserted the FTSE 100 firm in the aftermath of its recent price hike. The firm is marooned at the bottom of the FTSE 100 after plunging as much as 1.8 PC and shedding £1.6 bn of its value as shares slipped to their lowest level since 1999. Elsewhere, the pound has extended its post-budget gains against the dollar after U.S. Federal Reserve policymakers struck a cautious tone in minutes from the latest policy meeting at the central bank. Sterling has nudged up 0.2 PC to £1.3310 against the greenback but has dropped 0.3 PC against the euro after a closely watched PMI survey showed that the booming recovery in the eurozone picked up the pace in the fourth quarter. Fears about Brexit and consumer spending have led pub owner Mitchells and Butlers to ditch its interim dividend and put its next full-year payout under review. The decision caused investors to spit their beer out as the shares dropped more than 7 PC to 239p in spite of the Harvester and all bar one owners' sales outpacing rivals. Chief Executive Phil Urban said the business was not as profitable as when the decision was taken to restore the dividend in 2015. This had been caused by growing concerns about consumer spending in light of Brexit and the growing cost pressures put upon the pub industry through business rates and higher wages. Mr. Urban said the move not to pay a half-year dividend, which was 25p a share in 2016, was key in ensuring it could keep investing in its estate and meet other obligations such as debt repayments. Report by Bradley Gerard. Centrica is currently on course to close at its lowest share price since 1999 and since its 2013 peak, its market cap has plunged from over £20 bn to just £8 bn. Hargreaves Lansdowne analyst George Salmon blamed the latest dose of bad news on Centrica's business-facing units. He explained, Centrica isn't the only sinking stock in London this morning, however. Mothercare has become the latest big name from the retail sector to plunge on the softening UK market. Its shares have slipped 16 PC to a 14-year low after it swung to a first-half pre-tax loss. Usually stocks that plunge early in trading get a bit of a bounce from investors looking to snap up shares on the cheap, but Centrica is still languishing at a 17 PC loss as we approach lunchtime. That means it has shed £1.6 bn of its value in a matter of hours following that profit warning.